Understanding the tax and legal implications when selling S corporation stock is crucial for maximizing after-tax profits. Whether you're a business owner planning an exit strategy or a potential buyer, knowing the structure options and their consequences can save you significant money and headaches. When selling an S corporation, you have two primary options. You can sell your S corp stock, or you can sell the corporate assets while keeping the corporate structure. Selling stock is generally simpler. The seller deducts the money received from their tax basis in the S corporation shares. This basis typically reflects the capital contributed to the company, adjusted for generated revenue and distributed profits. When the sale proceeds exceed the owner's tax basis, capital gains tax applies. Asset sales involve more steps. Each asset needs an assigned tax basis, and the purchase price must be allocated among these assets. Different assets may be taxed differently. Some gains might be subject to ordinary income tax rates rather than the more favorable capital gains rates. Depreciated equipment sales can trigger recapture taxes at higher rates. For these reasons, sellers often prefer stock sales to minimize tax burdens, while buyers typically favor asset sales for better depreciation deductions and basis reset opportunities. A key consideration in stock sales is successor liability. When buying stock, the purchaser inherits all liabilities of the S corporation, including known and unknown debts, pending lawsuits, and tax obligations. To protect themselves, buyers conduct thorough due diligence and negotiate representations, warranties, and indemnification clauses. Sellers should disclose all outstanding liabilities to avoid disputes after the sale. The allocation of purchase price significantly impacts tax outcomes for both parties. The IRS requires allocating the purchase price among the corporation's assets. Sellers benefit from greater allocation to goodwill and intangible assets, which qualify for lower capital gains tax rates. Buyers prefer allocations to tangible and depreciable assets, allowing larger tax deductions in future years. Strategic allocation planning can optimize tax results for everyone involved. S corporation income passes through to shareholders, who report it on personal tax returns. Similarly, sale proceeds pass through but are treated as capital gains rather than ordinary income. Your stock basis determines the capital gains tax. This basis represents your total capital investment in the corporation, including what you paid for services, property, debt, and cash. Undrawn profits can increase your stock basis. For example, if your S corporation has $50,000 in undrawn profits in 1 year, your stock basis increases by that amount. For S corporations previously operating as C corporations, a built-in gains tax may apply. This tax is triggered when selling appreciated assets that were held when the company was a C corporation. Calculated on the difference between the asset's fair market value and its adjusted tax basis at the time of the S election, this tax applies at the highest corporate rate and can significantly reduce sale proceeds. Strategies to minimize this tax include waiting out the 5-year recognition period or allocating more value to goodwill. In certain situations, parties can use a Section 338H10 election to treat a stock sale as an asset sale for tax purposes. This provides tax benefits for buyers by stepping up the tax basis of acquired assets, potentially increasing future depreciation and amortization deductions. However, sellers may face higher tax liabilities as proceeds get reclassified as a mix of ordinary income and capital gains, rather than purely capital gains. Determining fair market value for S corporation stock is essential for structuring sales and avoiding tax disputes. Valuation factors include historical financial performance, future earning potential, comparable industry sales, and asset values. Private S corporation stock often sells at a discount due to limited marketability. Professional business valuation experts can provide defensible valuations for tax reporting and negotiations. The sale of an S corporation represents the culmination of successful business development. By understanding the tax implications, stock basis impact, successor liability risks, and special elections available, you can structure the transaction to maximize your after-tax proceeds while meeting your broader business and personal goals. Given the complexity of these transactions, consulting with tax and legal professionals is highly recommended before finalizing any S corporation sale.